On July 13th, the KOSPI, South Korea's primary stock market index, dropped more than 8%. In a single session, the decline triggered a market-wide circuit breaker and halted all trading for 20 minutes. The pain was heavily concentrated in the nation's technology leaders. SK hynix fell roughly 15%, while Samsung Electronics lost almost 11% by the close. South Korea's factories, banks, and shipyards remained standing. No physical infrastructure vanished, and no productive capacity dissolved over a single lunch break. The crash exposed a structural vulnerability hiding in plain sight, a catastrophe of market mechanics rather than economic production. A national stock index like the KOSPI is supposed to reflect the broad health of an entire country. It holds financial institutions, automakers, chemical producers, and consumer brands, effectively providing a diversified cross-section of the economy. But diversification gets warped by market cap weighting. As a company's stock becomes more valuable, it receives a larger share of the index. As AI spending exploded, memory chip valuations surged. By mid-2026, Samsung and SK hynix grew massive, crossing a critical 50% threshold. Hundreds of other companies could report record profits, and it wouldn't matter. If those two semiconductor giants stumble, they possess enough gravitational pull to drag down banks, defense contractors, and the rest of the national market with them. That concentration was dangerous on its own. Then, in April 2026, South Korean regulators approved a new financial product, single stock exchange-traded funds, or ETFs, that allowed up to 200% leveraged exposure. The response from retail investors was immediate. Between the launch in late May and mid-June, everyday investors poured approximately 8.2 trillion won into leveraged products tied specifically to Samsung and SK hynix. This capital didn't represent new, diversified investments. According to the Korea Capital Market Institute, money actively flew out of broader KOSPI funds. Retail traders were abandoning the wider market to place concentrated, amplified bets on the exact two stocks already controlling the index. The result was a highly pressurized layer of leverage stacked directly on top of a foundational structural flaw. To understand why that leverage is so volatile, we have to look at how these products actually operate. A 2x leveraged ETF promises double the return of a stock, but only for a single trading day. It executes a strict mandatory reset at the close of every session. This animated chart shows exactly how that daily reset causes something called volatility drag. The first line tracks an underlying stock rising 10% one day, then falling roughly 9% the next, landing right back at its starting price. The second line tracks a 2x daily fund over that exact same path. Because of the math of compounding percentages, the leveraged fund ends up losing money even though the underlying stock finishes perfectly flat. To maintain their specific mathematical targets each morning, these funds use pro-cyclical rebalancing. If the underlying stock goes up, the fund earns twice the move and grows its asset pool. To keep that 2x target the next day, it has to mechanically buy more exposure. Buying pushes the stock up, which forces the fund to buy even more. But the math works in reverse. If the stock drops, the fund's asset value shrinks. To maintain the correct leverage ratio, the fund is forced to rapidly sell off its exposure, pushing the price down further. In a calm market, this rebalancing is easily absorbed. But during a violent price swing, these massive funds are mathematically required to become indiscriminate mechanical sellers right when the stock is crashing. By July, global semiconductor stocks were already facing scrutiny from investors, questioning if AI revenue could justify massive valuations. At the same time, geopolitical risks spiked. Tensions in the Middle East threatened the Strait of Hormuz, presenting a direct inflation and energy threat to oil importing nations like South Korea. In the middle of this macroeconomic anxiety, SK hynix completed a massive $26.5 billion American depository receipt listing in the United States. For investors in Seoul who had been riding a historic memory chip rally, this highly anticipated event provided a psychological moment to take profits. On July 13th, that profit-taking cascaded. SK hynix entered a 15% freefall, and Samsung dropped right alongside it. As the shares plunged, the mechanics of those heavily traded 2x ETFs triggered. Trillions of won in leveraged funds were mathematically forced to shrink their exposure, dumping required selling pressure into an order book that was already panicking. The KOSPI halted because the external spark ignited the retail leverage, forcing two dominant stocks to drag down an entire country's market. That systemic risk is no longer contained to Seoul. When SK hynix listed its depository receipts on the Nasdaq, it opened a direct channel to New York. Almost immediately, at least 10 American fund managers rushed to file for their own single-stock leverage ETFs tied directly to this new U.S. ticker. This creates a continuous trans-Pacific loop. News breaking during U.S. hours moves the Nasdaq listing. American leverage products rebalance. That movement establishes a new price reality before the Korean market even wakes up to react. Macroeconomic fears over chip valuations and oil supply drove the initial selling. Leveraged ETFs functioned as the accelerant, where mechanical rebalancing turned a standard correction into a market-wide halt. This event proves that an ETF label or a national index designation does not grant magical immunity from corporate concentration. Diversification is determined by the actual math under the hood, not by the name on the fund. Daily resetting leverage feels efficient during a long rally, but the moment momentum reverses, it stops rewarding investor conviction and begins mathematically amplifying a system's underlying fragility. The next time a market looks perfectly diversified and practically unstoppable, look at its weight. You might just find two companies holding the fate of an entire economy.